If we see the here returns, no probability is given. When the probability is not given, it is called exposed. Standard deviation is equal to R mean A whole square divided by N. What is the portfolio risk made up of? 60% of X, 40% of Y. Hello, my dear students. Very good morning. I am Dr. B.S. Subramaniam, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Aid College, a Temple of Excellence, MYSURU. I am going to have Financial Management, 6th semester, Unit 3, Session 9, in favor of B.B.A. We'll go risk and return with portfolio management. In the last session also I have explained actually what is portfolio management. That is not diversification of investment. We can put entire money in one basket or entire money in one way. I think if you want, every investment has a risk. Always when we say that return, it is followed with a risk. More return, more risk, less return, less risk. If you take the more risk more and more, you may expect a more return. That's a common norm. But if he does not want to take the risk at all, especially official line, they does not want to take the risk. So what they can do, they can deposit in post office, they can deposit the money in the bank, the regular income will come. Assume that by chance, if they deposit about 10,000 or 1 lakh rupees in a bank and they will get the interest of 5%, means 5,000, it become 1 lakh 5,000 rupees. Easily they can get. But if they want to more, they have to diversification their amount in different cadre, in different, they may invest in share, either in a equity share or preference share. They may investment in bonds, they may investment in the debenture, they may investment in units, they may invest it in the real estate, so that there are so many categories are there. Diversification is there. We can diversify all these two. It is called portfolio management. So we'll move on to problem now. Stock of A. Here, see the problem. No, if we see the here returns, no probability is given. When the probability is not given, it is called exposed. When the probability is called ex ante, it is already decided. It is called exposed return. If the probability is given, it is called ex ante return. Here, there are two companies are there, A and B. These are all the returns. Find the expected return and standard deviation. Here, it is not called expected return. We can say that average return because they have not given what is called probability is not given, so that we can have it idea as average return and standard deviation. If they invest 70% in A, 30% in B, what is the portfolio return and portfolio risk? If the investor invests 75% in A, 25% in B, what is the portfolio return and portfolio risk if R is equal to 1? We'll move on to one by one now. Stock A. Returns year 2017, 18, 19, 2017, 18, 19. This is the year. Returns 12, 10, 8. This is the return. Expected return is equal to add and divide. That's all. Add and divide. Expected return is equal to, we can say that this is the deviation. Add the figure. This is sigma R. This is called average return. 30. How many items are there? 3. It is 10. You can say that R minus R mean A. Take the deviation. 12 minus 10 is 2. 10 minus 10 is 0. 8 minus 10 is minus 2. Square of this, R minus R mean A whole square. This is 4, 0. This is 4. This is 8. This is sigma R whole square. Then standard deviation is equal to root of R minus R mean A whole square divided by N. Standard deviation is equal to R mean A whole square divided by N. This is root of 8 divided by number of items is 3. 8 divided by 3, 2.67. So standard deviation is equal to root of 2.67, 1.63. This goes in favor of A. Then stock B returns. Here is given returns. What are the returns are? B. 749, 749, 749. Add the figure. 40. Sigma R. R mean is equal to 40 divided by 3. 13.33. RB minus R mean B. Take the deviation. 40. First is 7 minus 13.33. 6.33. 14 minus 13.33, 0.67, 19 minus 13.33, 5.67. Square of this RB minus R mean B whole square, 6.33 into 6.33, 40.06, 07, 0.67 into 0.67, 0.44, then 5.67 into 5.67, 32.1, 32.15. Add the figure. 32.14 plus 0.44 plus 40.07, 72.6589. Standard deviation is equal to root of RB B whole square divided by N. This is root of 72.6589 divided by 3, root of 24.22. Standard deviation is equal to 4.02 percentage. Here standard deviation of A is equal to 1.63. Standard deviation of B is equal to 4.92. So regular you got. Then the problem goes. Here, the investor invests 70% in A and 30% in B. What is the portfolio return and risk? So, we can move on. Weight of A is equal to 0.70. Weight of B, 0.30. So, portfolio return on portfolio, R mean A, WA plus R mean B, WB. Come back here. What's the expect? R mean that 10 into 0.70 plus 13.33 into 0.30. So 10 into 70 is 7.33. 13.33 into 0.30, 3.999. This is 10.999. Then regarding the portfolio risk, standard deviation square P is equal to root of formula. What is the formula? Standard deviation A square WA square plus standard deviation B square, standard deviation A square WA square, standard deviation B square WB square, 2 into standard deviation A, standard deviation B, weight of A, weight of B into R. See the formula? Standard deviation A square, weighted A square, standard deviation B square, weighted B square, plus 2 into standard deviation A, standard deviation A, weight of A, weight of B into R is equal to root of. What is standard deviation of A? 1.63 whole square into 0.70 whole square plus standard deviation of B 4.92 whole square into 0.30 whole square plus 2 into what is standard deviation A? 1.63 into 4.92 into 0.70 into 0.30 into R is 1. Simplify this. One point 63 into 1.63, 2.65, 6 into 0.70 into 0.70, 0.49 plus 4.92 into 4.92, 24.21 into 0.30 into 0.30, 0.09 plus 2 into 1.63 into 2 into 1.63 into 4.92 into 0.70 into 0.30 into 1. 3.3682. This is equal to root of 2.66 into 0.49, 1.3034 plus 24.21 into 0.09, 2.1789 plus 3.3682. Add. This is root of 1.3034 plus 2.1789 plus 3.3682, 6.85. Root of this, standard deviation is equal to 2.62%. This is portfolio risk. So this goes in favor of, this is invested 70% in A, 70% in B. Then next we have got weightage 75% in A, weight 0.75, weight B 0.25. Return on portfolio, R mean A, WA, R mean B, WB. What's your R mean? 10 into 0.75 plus 13.33 into 0.25 is equal to 10 into 0.75, 7.5 plus 13.33 into 0.25, 3.33, 25 plus 7.5, 10.8325. Then portfolio risk, is equal to root of standard deviation A square WA square plus standard deviation B square WB square standard deviation A square WA square standard B square WB square 2 into standard deviation A standard deviation B weight of A weight of B into R root of we'll go. What is our standard deviation A? 1.63 whole square weight of A 0.75 whole square. What's your standard deviation of B? 4.92 whole square into 0.25 whole square plus 2 into 1.63 into 4.92 into 0.75 into 0.25 into 1. This is root of 1.63 into 1.63 2.65 into 0.75 into 0.75 0.5625 plus 4.92 into 4.92 24.21 into 0.25 into 0.25 0.0625 plus 2 into 1.63 into 4.92 into 0.75 into 0.25 3.0073 is equal to root of 2.65 into 0.5625 1.4906 plus 24.21 into 0.0625 1.513 plus 3.0073 add 3.0073 plus 1.4906 root of 6.01 root of this standard deviation is equal to 2.45%. This is portfolio risk. Then we move on to another problem. Here, written X is 24%, 36, 28, 70, 30. This is made up of 60%, 40. What is the portfolio risk made up of? 60% of X, 40% of Y. Then here, returns X, stock X, returns 2436 add this is sigma R average return is equal to sigma r divided by n. 60 divided by 2 is 30. Take the deviation r minus r mean. 30 is your number. So 24 minus 30 is minus 6. 36, 30 is 6. Square r minus r mean whole square. 36, 36, 72. This is sigma. So standard deviation is equal to, square is equal to sigma r minus r mean x whole square divided by n. Root of, this is r minus r mean whole square is how much? 72. 36. Root of 36 is 6. So this goes in favor of r. Then stock y. What are the returns are? 28, 24. This is 52 sigma r. Average return 52 divided by 2. This is 26 r minus r mean y. 28 minus 26 is 2. 24 minus 26 is minus 2. R mean y whole square. This is 4. This is 4. This is 8. Standard deviation is equal to root of r mean y whole square divided by n. This is root of 8 divided by 2. This is root of 4 is 2. This is your standard deviation. Then portfolio risk. Then return on portfolio or this is a company. R mean X, WX, R mean Y, WY. What's your R mean? Here is R mean is 30, weight 0.70, R mean Y 26 into 0.30. Simplify. 30 into 0.70, 21, 26 into 0.30, 7.8, 28.8%. Then portfolio risk. Root of standard deviation x square, W x square, standard deviation y square, W y square, plus 2 into standard deviation x, standard deviation y, Wx, Wy into r is equal to root of, what is standard deviation? 6 square. What's your weight? 0.70 square. Then 2 square into 0.30 square plus 2 into 6 into 2 into 0.70 into 1. This is root of 36 into 0.70 into 0.70, 0.70 into 0.70, 0.49 plus 4, 0.30 into 0.30, 0.09 plus into 2 into 0.70 into 0.30, 5.04. This is 36 into 0.49, 17.64 plus 4 into 0.09, 0.36 plus 5.04 plus 5.04, 17.64 plus 0.36 plus 5.04, 23 root of 23.04, root of this 4.8. With the problem 4.8%. So another one here, this one C, portfolio risk. WA 0.60%, WB 0.4%, R is equal to 1. Standard deviation is equal to root of standard deviation x square, W x square, standard deviation y square, WY square plus 2 into standard deviation x, standard deviation y, weight of x, weight of y, 2 into standard deviation y, standard deviation x, weight of x, weight of y into R, root of standard deviation x. What is standard deviation? X is 6. 6 square into 0.6 square. What is standard deviation y? Standard deviation is 2 square. This is standard deviation. Y is 2 square into weight is 0.4 plus 2 into standard deviation x is 6 into 2 into 0.60 into 0.40 into 1, root of this is 36 into 0.60 into 0.60, 0.60 into 0.60, 0.36 plus 4, 0.4 into 0.4, 0.16 plus 2 into 6 into 2 into 0.60 into 0.40, 5.76, 36 into 0.36, 12.96, 4 into 0.16, 0.64 plus 5.76, root of this 12.96 plus 0.64 plus 5.76, 19.36. This is square. So standard deviation is equal to root of this 4.4. 4.4 percentage. Then if you want return on portfolio, R mean X, WX, R mean Y, WY. You say, what is it? R mean X, mean of X, mean of X is 30, this is 26, 30 into 0.60, this is 26 into 0.40. So 30 into 0.60, 18, 26 into 0.40, 10.4. This is 28.4% risk of return. So this formula, you must be very, very careful about this. Because no space is there. I have done this. I hope you understand. I will solve about the 4 problem. 60% of it for the R is equal to 1. Hope you understand. We solve the problem one by one. You understand the particular one. Hope we have got the problem. What is actually we got here, no? Especially for this weightage, no? If we go to the weightage, no? First is root of standard deviation x square, then weighted x square plus standard deviation y square, weighted y square plus 2 into standard deviation x, standard deviation y, weight of x, weight of y into R. What's the formula? Root of standard deviation x square into weighted average of x whole square plus standard deviation y square, w, y whole square plus 2 into standard deviation x, standard deviation y, weight of x, weight of y into root of these. I think we have solved the problem. We'll have some more problems in the next session. Till then, goodbye. Meet in the next session.